In the third module, we will deep dive on how to manage accounting activities using SAP ERP. In particular, let's first start by highlighting some of the differences between the two main types of accounting within an organization, managerial and financial accounting. First of all, let's start with some definition. Managerial accounting, financial accounting is a specialized branch of accounting that keeps track of a company's financial transactions. In particular, using financial guidelines and standardized rules, the transactions are recorded, summarized, and presented in financial reports, named also financial statements, such as income statement or balance sheet. Instead, managerial accounting or management accounting is the process of preparing management reports and managerial reports, providing accurate and timely financial and statistical information which helps manager in taking day-to-day decisions and also long-term decisions. Financial accounting in practice gather data and summarize information to prepare financial report. In these slides you can see as example the structure of the balance sheet, which is one of the possible reports related to financial accounting. Beside balance sheet, we will see that income statement and financial statement, which are then delivered to all organization management, investors, lenders, suppliers, tax authorities, and other stakeholders. Here you see an example of the structure of the balance sheet, but we will analyze this more in detail in the following slides. Here instead you can see an example of a document in the field of management or managerial accounting. Management accounting in particular generate monthly or weekly reports for organization internal audience, such as department managers, such as chief executive officer, and so on. These reports typically show data such as amount of available cash, sales revenue generated, amount of order, state of accounts payable and accounts receivable, condition of raw materials, inventory, trend charts, variance analysis, and other statistics. In particular, in these slides, you can see a particular example of management accounting document named the job cost sheet related to a particular item, the wooden cargo crate. The key difference between managerial and financial accounting is essentially the fact that the managerial accounting, so management accounting, aimed at helping managers within the organization decision-making process. So managerial accounting support decision-making process in company, while instead financial accounting has been conceived with the main aim to provide information to third parties outside the organization, like as investors, like as regulators, like as tax authorities, and so on. So the target is external, while the target of managerial accounting is internal. More, financial accounting being, target for an external audience is something which is mandatory to be designed and published, while instead managerial accounting is optional. The good thing is that in order to implement financial accounting reports and activities, you can rely on some standards like GAAP for US, IFRS for US, and AIS for China. Instead, for managerial accounting, no one particular standard actually exists, and company can define their own procedure, even if some what we call managerial accounting techniques exist, like as job order costing, like as activity-based costing, like operation costing, and so on. There is a linkage, of course, between financial and managerial accounting, which is the fact that financial accounting is the basis of management accounting. Because start from the overall cost present in the income statement of the company, which is a financial document, the financial accounting document, management accounting is able to reallocate this cost on different cost items in order to understand the level of efficiency of the company and identify potential areas of improvement. Linked to this, there is the concept called cost center. The cost center is the basic concept in management accounting and represents essentially the main elements where the costs are allocated. In particular, as you can see in the slides, costs are first, let's say, separated by location or organizational elements in which they are incurred, such as departments, such as geographical areas, such as projects, and so on. And then they are allocated to cost center, like products, like activities, like processes. Of course, these cost centers are often linked to what we call transaction documents, like job sheet, like sales order, like production order, which becomes, the main report, the main documents of managerial accounting, where all the information on cost are summarized. If we take again the example that we already seen in previous slides, we can see that in this case we have an example of managerial document which is named production order or job sheet. In particular, in this case, what we have called the organizational element is the B3 department, so the location where the costs are incurred. The cost center is the wooden cargo rate, so the product for which we are allocating costs, and the cost items involved are all those that you see printed here in this part of the table, so direct materials, direct labor, and manufacturing overhead. This is exactly an example of how to summarize cost information related to a particular cost center, the wooden cargo crate product. If it is clear, now let's focus our attention on financial accounting, and in particular, let's deep dive a bit in what are financial accounting principles and main reports in order to understand the nature of these documents. First of all, what is financial accounting? Financial accounting is essentially concerned to all that we hear as external people about companies. So profits, so revenues, so shares, so assets, so debts, and so on. These information are all communicated to the external market, and so it plays a fundamental role in determining market's company perception, such as the share price of the company, the market capitalization, the credit ranking, and so on. So all these, market aspects are determined by considering information included in financial accounting documents. In details, financial accounting identifies data and information that a company must collect, organize, and present to what we call shareholders, let's say people who owns the company and has direct interest in the company, and stakeholders, let's say all the people that have indirect interest or indirect relationship with the company, such as banks, such as bondholders, such as customers, such as suppliers, such as public authorities. And that's why companies are required to publish financial accounting, because by publish financial accounting, they are able to provide in a public way data for their shareholders and stakeholders, and so accomplish their normative duties. All this information are summarized in what we call the annual report or company financial statement, which essentially includes information about company assets and liabilities, an economic snapshot of the company through their income statement, and an overview of the cash liquidity situation of the company with the cash flow statement. Of course, financial accounting, as we already introduced before, must follow some accounting principle or standard. In particular, we have IFRS for Europe, a GAAP for US, which orient and define the format of financial standard, the items that need to be registered, and the rules to register them. So they are very strict guidelines to be followed in designing this kind of documents. In particular, if you focus the attention on the GAAP standard, which are US based, we can see that they are the most used by US company, and they state that the annual reports of a company should be constituted by 5 compulsory documents. You have first the balance sheet, which describes essentially the monetary value of all the assets and the rights that are, that relate to a specific company at a given point of time, which is usually the end of the year. Then we have the statement of income, which instead describes the economic position in terms of revenues and costs of a company, which comes from the physical transaction incurred during a year, so in a specific amount of time, which is generally the 1 year, and which is the end of the year in particular. Then we have what we call the statement of changes in shareholders' equity. So, in particular, companies are interested in describing how the shareholders' equity composition has varied during the years, according to physical and financial transactions that has interest the company during the years. Then we have the statement of cash flow, which summarizes the results of the financial transaction undertaken by the company during the year, and so gives an idea of the liquidity of the cash situation of the company. And finally, we have also, some extended rules followed by the company in designing these documents, which are essentially called notes to financial statements. So a description of all the rules followed and the hypothesis made when designing this kind of documents. In particular, when designing these annual reports, apart from the structure and these 5 pillars, these 5 typology of documents, company must follow also some principle. The first one is called full disclosure principle, stating that companies are obliged to include information in the reports only if this information is important to an investor or a lender using the financial statement. And this information should be disclosed in the financial statement or in their notes. Then we have the principle of conservatism that states that if a situation arises when there are 2 acceptable alternatives for reporting an item, companies should always choose for the worst scenario, meaning that it's always better to anticipate losses which could not be incurred by the company, while instead ever include unsure gains. Then we have what we call the matching principle of the accrual by basis of accounting principle, which we are now going to describe it more in detail. The matching principle of the accrual basis principle states that companies must record events essentially based on economic activity rather than financial activities. So, as you can see here, under the accrual accounting rules, revenues are recorded when they are earned and realized by the company, regardless of when the actual payment is received, and similarly, costs are matched to revenues regardless of when they are actually paid by the company. So, accrual-based accounting is opposed to cash-based accounting. So, this principle states that the documents of the company, particularly the income statement, should be driven by an economic perspective instead of a financial perspective. Let's see an example, this with an example. Let's imagine that today our company sells a product which will be paid by the customer after 1 year. This means that today finished goods are delivered to customer and invoices are issued but not yet paid, and this is an economic event. After 1 year, invoices related to the sold finished goods will be paid by the customer, and that is the financial event. According to the accrual basis accounting, revenues related to finished goods are recognized in the net profit of year 0, so today, thus affecting the income statement, whereas no effect on the net profit are recorded in year 1. At year 1, instead, we will register the financial event which will affect another document, the cash flow statement. If this is clear, it's also useful to highlight that listed companies are also requested to provide more documents than the one we discussed so far. In particular, listed documents need to report also, need to design also the report of independent auditors, the report of a supervisory board, and in particular the managerial report. Which is, the annual overview of company activities, transaction, and situation. We don't go too much in detail on this, but if you want to have a look at an example, I just put the link to the buyer report for the last